Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra. Well, if mutual funds is on your mind and if you've been very interested in this space, looking at the remarkable returns that one gets as opposed to the traditional forms of investments like fixed deposits or savings accounts or even some of the debt schemes right there, then this space is what is going to be interesting for you to watch, because today on this show, we are going to be talking about the new fund offers. Now, what exactly are NFOs all about? And, how can you really look for opportunities in these? We'll try to understand that. And joining in to help us with all those questions is Mr. Chintan Haria. He's the head of product development and strategy at ICICI Prudential AMC. Welcome, Mr. Haria, and great to have you with us on Business Today TV. Well, let's dive right in. And I want to begin by understanding, for all those viewers who are just yet to start off their journey via mutual funds, or they have just started, but they are not yet aware about all the facets of mutual funds. So help us understand what exactly is an NFO and how is it different from a mutual fund, really?
Sure. Thanks, Sakshi, and always a pleasure to connect with all of your audience. And I think when people talk about mutual funds, the awareness now versus 17 years back when I started in my career in the mutual fund industry is quite different. I think thanks to channels like yours, which help investors learn a lot more. I think we've seen significant improvement in people's understanding of mutual funds. But to answer your question, a NFO or a new fund offer is essentially a new product which the mutual fund is bringing in. It essentially is something which adds to the overall bouquet of the mutual fund offerings that a mutual fund has. So, for example, there are existing schemes within mutual fund which you may be investing in. And then there may be some additions which are happening in terms of either a sectoral fund or a thematic fund. And in this instant case of the NFO, which we are talking about, a fund which basically has equal weighted indices. So NFO is nothing but trying to bring one more product, which then ultimately becomes a normal mutual fund scheme. So NFO is a mutual fund scheme itself, just that it is something new or a variety, which basically adds to the overall portfolio bucket, because you don't need only one kind of fund. You may have at different points of time in market different requirements from an investment product perspective. And so we basically are trying to build an entire bouquet. And as part of that, you are seeing probably many mutual funds launch NFOs. So NFOs in simple terms is new fund offers, which is bringing a mutual fund product, which is different from the existing products which are there in the mutual fund to help you build your portfolio.
Yes, exactly. So also help us understand, if there are any benefits of these new schemes that get launched as new fund offers versus the existing schemes that one may have already invested in. Should one really look at an NFO as something that is not existing in the current realm of the market scenario? Is an NFO, whenever it's brought in, does it cater to the current market environment and is built in a different way than the traditional mutual fund schemes?
Sure. So I think from a timing perspective, some of the NFOs are timed in a way that they are ripe in terms of when their launch should happen. Like we recently launched a public sector enterprise related fund because we do believe next 3 years PSUs are going to do well, given their valuations are at a discount to the market. So that can be the case. But there are also other reasons. For example, if you get approvals and you want to build that product bouquet, you may launch. So investors should look at their overall portfolio balance, and it's not necessary that if an NFO has come, the timing is perfect for you to invest.
Okay.
Look at your overall balance and then look at whether the new product is fitting in, because the new product will bring in something different to your overall portfolio which you may not have. I'll just like to give an example. That in February 2022, we launched the Silver ETF and the Silver Fund of Fund. They were new to the industry. That was the first product on silver from a financial investment perspective. So it brings something new. It makes it easy for you to invest. It made sense for you to start building your portfolio in silver through that particular product. So that's something. And if you see silver, it's corrected significantly from the peak. So people can take advantage of that. So bringing in new products via NFO is also giving an opportunity at a later date for investors to keep building in their portfolio. Because whenever there's a correction, they can add on to it.
Right. So NFOs usually come for a particular period. Like you've also launched your NFO, which we will talk about in the later part of the interaction. So you launched it yesterday, that's September 14th. Then you have a period of, say, 15 days for this NFO to be open. So is this the only window when the investors can invest in it? How does it work?
Sure. So if we look at the instant case, that is the ICICI Prudential Nifty 50 Equal Weight Index Fund, it's essentially an NFO on the index fund route. And as per law right now, you have a 15-day window, which is a maximum for you to basically have your NFO period open. So in the NFO period, we reach out to people. If they like the product, we collect the money, and then the NFO period ends on 20th of September. The minimum investment is around rupees 5,000. And once the NFO period gets over, the money collect. People are basically given units against that on the allocation date. And once the allocation is complete, once the people have got the units, then again at a later date, it opens up for repurchase and it opens up for subscription. So you will find that it is an open-ended scheme, but maybe after 5-6 days of the NFO closing, people can again freely invest in the NFO, much like how they do in a mutual fund scheme, and it becomes an open-ended mutual fund scheme after that.
Okay. So help us understand then what are the few things that you advise investors to look for before they take the step or decision of investing in any particular NFO? What are the things one should go through?
Sure. So the first thing which people should look at when they're investing in an NFO or in any other investment vehicle is that whether that suits their investment style and their asset allocation. In India, none of us are taught asset allocation, so people don't know what asset allocation is. But asset allocation is simply what part of your allocation should be to equity, should be to debt, should be to gold, silver, and any other financial instrument that you need to allocate to. Within equity, then, if you already have, let's say, large cap active, large cap passive, and you feel that, okay, you need to add silver, you add silver. The equal weight product, which we are going to talk about, if that adds value to you and you understand that product, because some products may be a bit complicated for people to understand at the initial stage, but as they increase their literacy of financial investment, especially mutual funds, then it will become very easy for them to understand those nuances of those products as well. And then they can add that. So it's essentially whether a product fits into what you require right now at an NFO stage, or it can be later on also that it can be fitted into your product portfolio, depending on your overall balance.
Okay. Now, let's understand the details of your own NFO that you brought about, ICICI Prudential Mutual Fund, the Nifty 50 Equal Weight Index Fund that you brought in as the NFO. What is the significance of it? What's the USP of this? How will this work? And who should invest in this NFO really?
Sure. So if we look at traditionally on the mutual fund side, there are active funds where the fund manager is buying and selling stocks. Those are the traditional active funds, and large cap, mid cap, small cap, there are various categories. In India, in the last 3-4 years, there is index funds and ETFs, which are becoming more and more popular. They are known as passive funds, where there's no fund manager buying and selling or picking and choosing the stock. But it's essentially the portfolio manager, or the person who's managing the fund, is just replicating an underlying index which has a particular methodology. So you would have heard of, let's say, the Nifty 50 index funds or the Sensex index funds, or the Nifty Next 50, etc. Those are based on small cap, mid cap. Those are already indices which are in place. They are based on market capitalization. So the stocks are selected on the basis of market capitalization, and their weightages are also in a way that the larger stock in terms of market capitalization gets a larger weight. So typically, if you look at it, the top 5 stocks will have 7%, 8%, 9% weight. Even in the Nifty 50, you have market capitalization weights, so you will have larger stocks having larger weight. In this instant case, and we've seen this, as an interesting idea, instead of having larger weights to larger stocks, the Nifty 50 names have equal weights of 2% each at the time of balance. And because they have an equal weight of 2%, the smaller names and the big names both have an equal chance of providing alpha to you. And in broad-based market rallies like we've seen from 2020 to 2022, where a lot of the sectors which otherwise were not prevalent, like metal, etc., they add value to you. So the broader-based index of equal weight 50 stocks gives you a alpha when probably there's a broad-based rally relative to a market cap base. So I think it's a complementing product to the existing product that you have. And I think all investors ultimately can invest in it. It's just that they need to understand what the proposition is.
Right. So what kind of returns can one really expect from this? If we see the Nifty 50 stocks, what is the expectation there? And in this, especially when you're going to be giving equal weightage to all the Nifty 50 stocks, how does one expect, the kind of returns?
So I think the question on returns is always interesting because the market returns are not necessarily equal to the investors' returns, because the investors, because of their greed and fear, tend to end up investing at the wrong time and divesting at the wrong time. So I answer that question always in a very simple term, that the returns in each product will be linked to the market, and that applies to the market cap based indices as well as an equal weight index. The most important aspect is how disciplined you are in terms of your investments. When markets fall, are you able to take advantage of it by putting in more money rather than taking out money by being fearful? So I think it is important to get that emotional greed and fear right, and then the market returns will take care of your wealth creation. So how much returns will you get in any equity portfolio are anyways a function of the market. And if we look at India's next 3 years, 5 years growth trajectory, we are looking at a double-digit nominal index or nominal returns in the GDP or nominal GDP growth, which can then get reflected in the equity markets with more volatility. So it's the volatility which makes people get afraid and lose out in the equity market.
Yes.
If you're a patient investor, you will get market returns which are commensurate and your wealth creation will happen. So it's important to get two things right: asset allocation and emotional greed and fear. The rest will take care of itself.
Okay, noted. Those are very, very important points for all the fresh and new investors or first-time investors really looking for how to begin, how to approach these funds, the kind of trades that you will need to have as a patient investor to be able to get the maximum kind of returns right there. Since you said that you're positive about the markets going forward from here, three years from now, we are already approaching these record high levels at the moment. There is, some experts do believe that India is perhaps better placed than the other emerging markets at this point in time. We have been an outperformer. They still believe the outperformance to continue going forward from here. But at one point, some people also believe that, we are overvalued at this. I want to take your view here on the markets going forward from here, and how does the valuation part come in?
Sure. So if you look at valuations on a standalone basis versus long-term average, we may look slightly more expensive on a forward basis. But more importantly, if you look at the rest of the world, given that we have food security, given that we have reasonably good energy security, and we have a younger population with a growing working population, it does seem India is a nation which is going to attract a lot of foreign capital as well. And domestic consumption as well as the revival of manufacturing is something which will hold us good in the next 3 to 5 years. So we are positive on the markets or the positive of the trajectory of the Indian market.
Okay, and do you have any targets in your mind for
what
Nifty?
happens in the rest of the world in terms of increasing rates?
Do you also have any targets for the Nifty?
Yeah, I mean, you can safely assume that Nifty will reflect India's GDP growth.
Okay. And what about Nifty Bank? We've seen record high levels on the Nifty Bank. Finally, after a long time of underperformance, the Nifty Bank is taking leadership. Do you believe the Nifty Bank will be a definite contributor and a leader of the pack in the next leg of the rally?
Yes. So after 4 years of underperformance, I think banking, after the cleaning up of balance sheets and the growth because of inflation also coming back in their loan growth, are likely to benefit. And now with the consolidation in the banking industry also happening in a very big way, we do believe that that is a space which will probably hold up strong in the next 3 to 5 years and lead us to the rally. Plus, whenever foreigners do come into any market in terms of their investments, it is the banking sector which probably gets a disproportionate share. So we are very positive on that particular segment, given that next 3 to 5 years of India's growth will be fueled by the banking sector.
Okay, understood that. Well, thank you so much, Mr. Haria, for being with us and sharing all your thoughts and insights about the NFO space, mutual funds, your own NFO. All the very best for that too. And, giving a glimpse of as to how should investors, first-time investors, really be approaching markets at this point in time. Thanks a lot.
Thank you, Sakshi. Thank you.
If you like the video, do like, comment, share and subscribe.